precious metals, gold and silver, are going to continue to outperform bonds and treasuries and government bonds. But I think, unfortunately, the gold market is so ignored, and investors and fund managers and financial professionals still think that bonds are safe. It's still part of that 60-40 deal, right? 60 stock, 40 bonds. And but I think that's going to change. That's one of the themes, I think, for 2025. People are going to wake up to the fact that they need some precious metals, be it the physical gold and silver, or even the miners.
This year has been remarkable for precious metals, with gold and silver as top-performing asset classes. Bullion has delivered exceptional returns, driven by increasing demand for safe haven assets in a volatile economic environment. Market expert Mario Innecco highlights gold's consistent outperformance against 10-year Treasury futures since 2011, with only brief periods of consolidation. This long-term trend underscores the likelihood of precious metals continuing to outpace bonds and government debt, mainly as economic uncertainties mount. The bond market indicates that the Federal Reserve will face increasing challenges in 2025. The central bank finds itself in a difficult situation, unable to control inflation through interest rate hikes while dealing with unsustainable fiscal spending and a potential sovereign debt crisis. Consequently, investor interest in alternative assets, such as gold, is expected to rise. Although the outlook for gold in 2025 appears positive, experts warn that the gains may not be consistent. Historically, when gold has posted annual returns exceeding 20%, it has typically averaged a 12% increase in the following year. This pattern has occurred 5 times over the past 25 years, with only one exception, which was in 2021. Gold's recent performance has been nothing short of remarkable. From a February 2024 low, it surged 54% to a late October peak of $2,800 without a significant correction, marking a parabolic 70% advance from its 2022 lows. Innecco points out the untapped potential of the gold market as a hedge or alternative investment. By 2025, we may see more allocations to physical gold, silver, and mining stocks. However, due to their higher risk, he advises caution with speculative investments in junior mining companies, recommending they only make up a small part of a portfolio. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Or it is the big theme going forward, is that bonds are not a good place to be in the long term. But why are funds, pension funds, investors still going into bonds? Well, it's because they don't know much about gold and silver, and how gold and silver really are real money and safe assets. And they still think they're still in that paradigm in which they think bonds are the safest place to be. But I've looked at this before, and I'll show it to you now. If you look at the price of gold in the 10-year Treasury note future, it's been pretty much a one-way street higher for gold. Yes, there was a consolidation between, after 2011, but the trend is higher. And what does that mean? Well, it means that precious metals, gold and silver, are going to continue to outperform bonds and treasuries and government bonds. But I think, unfortunately, the gold market is so ignored, and investors and fund managers and financial professionals still think that bonds are safe. It's still part of that 60-40 deal, right? 60 stock, 40 bonds. But I think that's going to change. That's one of the themes, I think, for 2025. People are going to wake up to the fact that they need some precious metals, be it the physical gold and silver, or even the miners, the big mining companies. Maybe not the mining exploration, the junior miners, but yes, that's the way I see it. Even though I'm still bullish on speculatively speaking, I think it's good to have some junior miners. Exploration, I have some. Of course, I'm not going to bet the whole house on it, but I think that's the way forward. And bonds, in my opinion, the only place to be if you want to finance, and if interest rates don't go down, you can always reinvest at a higher rate, so it's safer. But again, fiat currencies and the debt that backs them is going to continue to lose value, and it's going to be a losing proposition, and I think it's going to hurt millions, hundreds of millions of people across the West, because a lot of the pension funds that are run by governments, by states, by companies, they're going to keep piling your savings, unfortunately, into these bonds. Hopefully they will wake up and realize that it's good to have some gold and silver. Even if you're not going to put the whole thing in it, you should have some insurance.
Treasuries faced renewed pressure during a holiday-shortened trading session as investors showed hesitancy to commit funds to long-term U.S. government debt. Benchmark 10-year yields climbed to 4.62%, increasing by about 3 basis points, while the gap between 10-year and 2-year yields widened to 28 basis points, nearing its steepest level since 2022. This steepening trend in the yield curve highlights a growing preference for shorter-term securities in an uncertain economic environment. Trading volumes were notably reduced, operating at just 50% of normal levels due to the abridged session. Despite these lower volumes, the continued rise in long-term yields underscores lingering concerns about fiscal policy and the broader economic outlook. Market analyst Mario Innecco observes that while Treasury markets may experience some stabilization in the near term, the longer-term prospects remain clouded by uncertainties surrounding fiscal discipline and potential increases in government spending. Recent discussions about removing the debt ceiling and the possibility of expanded fiscal outlays have added to these concerns, amplifying skepticism about the sustainability of the U.S. debt market. The steepening yield curve reflects investor caution as they weigh the risks of higher borrowing costs and fiscal imbalances against the need for safe haven assets. With yields already elevated, any recovery in the Treasury market will likely be gradual, contingent on more precise signals about fiscal responsibility and economic stability. Let's get back to the interview.
I've seen a few things that are quite interesting over the last few days. I saw that on early Saturday morning, the U.S. Senate, a bill to continue to keep the U.S. government open. Sometimes you wonder if the best thing would be to really close the government. I think things would run much smoother. But anyway, it went through. There was a danger of the government shutting down. And right on Saturday, just before Christmas. But one of the things I read in the FT about the process, and I think the Senate passed it quite easily, is that the incoming administration, or President-elect Trump, they asked the Congress and Senate to scrap the debt ceiling. And yes, in a way that would be more positive in terms of not having to go through this every 2 years, putting the markets under pressure, debt markets, treasury markets. But the other thing that's interesting, one of the senators, and this could be biased, of course, but he said that the incoming administration wanted an extra $4 trillion of spending. I'm not sure if that's true, but I think the other side of the coin of having no debt ceiling is that it becomes a lot easier to borrow and spend. And so even though I think the Treasury market could recover a little bit, we've seen yields rise quite a bit ever since September 18th, when the Fed started cutting rates. The 10-year yield has gone up almost 1%. And I recently interviewed Simon Hunt, who's a geopolitical analyst, economic analyst in Dubai. He thinks we're going to continue to see these regional wars, and it will culminate in 2028. And I'm not even sure about that. It could be sooner than that. Let's hope it doesn't happen. But what else is going on? Well, I had a quick look at the markets this morning. Of course, it's going to be very quiet. Tomorrow is Christmas Eve, but I've seen that silver is trying to get back up towards 30. Spot silver, gold is up slightly as well. And keep an eye on Treasury yields. Yes, we've corrected quite a bit. We've come up quite a bit in terms of yields since it's going to be like back in the 70s when they used to call bonds certificates of confiscation, because you might get your $100 back. Usually when you invest in a bond at par, for example, $100, they pay you back at maturity $100, but at $100, it's going to be buying you a lot less in 5, 10, or 30 years' time. Not the place to be. That's the way I see it. And it was snowing a lot last night. It's still snowing today. It's going to keep snowing, but I think it's going to stop tomorrow, Christmas Eve. And it's going to be, after that, we're going to get some sunshine, which will be nice. And hopefully we'll be doing some skiing.
The financial landscape continues to evolve, with precious metals demonstrating resilience and long-term potential amid growing economic uncertainties. As investors navigate rising yields and fiscal concerns, the appeal of gold and silver as reliable alternatives becomes increasingly evident. While recent gains suggest the possibility of near-term consolidation, the broader outlook underscores the enduring value of these assets in a diversified portfolio. Careful consideration of market trends and prudent allocation strategies will be crucial for optimizing returns in an unpredictable economic environment. How do you perceive the role of precious metals in addressing the challenges posed by fiscal imbalances and rising yields? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.